afternoon, everyone. My name's Stephen Walters and I'm Chief Economist of the Australian Institute of Company Directors. It's my great pleasure to be here with my colleagues representing the Australian Business Economists Group, and I'll introduce my colleagues in a moment, but we're very, very pleased that we got the invitation from the Economic Society to attend today at such an influential and prestigious event, so we're very, very pleased to be here. Let me introduce my colleagues. So to my immediate right is Bessa Dedder. So Bessa is Chief Economist of the St George Banking Group, and she's been in that role since 2008. And prior to joining St George, Bessa was Senior Strategist and Economist with the Commonwealth Bank for nearly 8 years, and before that was an economist with the Colonial Group. On the far side is Bill Evans. So Bill is Managing Director of Economics for Westpac, where he's worked since 1991. Before that, Bill was Treasurer with the Commonwealth Bank of Australia and was prior to that Director and Head of Financial Markets at Schroders Australia for 8 years. And Bill previously was at the Reserve Bank of Australia. And in the centre is Warren Tees. So Warren is Head of Macroeconomic Conditions at the Commonwealth Treasury and heads up both the Sydney and Melbourne offices of the Treasury. Previously, Warren held roles in the private sector at UBS, Morgan Stanley and Schroders, and also worked at the Reserve Bank and the OECD. Myself, so I've been at the Institute of Company Directors just over 15 months. I've spent most of my career, like the others, in banking with JP Morgan Investment Bank for 15 years, Norwich Union in the UK for 5 years, and Access Economics in Melbourne. And I also spent some time as an economist with the Treasury in Western Australia. Importantly, we're all members of the Executive Committee of the Australian Business Economists. And in fact, Bill, for 8 years, was chairman of the Business Economists and is a life member. So the agreed format is that each of my colleagues is going to make some prepared remarks for about 5 or 10 minutes. Then I'll facilitate a question and answer session, and then there'll be plenty of time to get questions from the floor. So please start thinking up your questions. But Bessa, if I can ask you to kick off, and then we'll move to Bill second and then Warren third.
I guess when I thought about this, I thought, well, how has 12 months really changed? And 1 year has made quite a big difference in the global economy and global markets. If we go back 1 year ago, the Fed had only delivered one rate hike in its tightening cycle, and the markets were wondering really when the next one would come because it had happened 6 months prior. And it's really had been the only central bank that had tightened at that point. The word deflation was still being whispered in financial markets. Trump wasn't yet in power. Brexit had only just happened. Some fears of a Chinese hard landing were still prevalent. And the global economy was looking fragile, and bond yields were still trying to find a bottom at this time last year. 1 year forward, and the Fed has hiked 4 times in this tightening cycle. The Fed's dots indicate that they're likely to hike again one more time this year, 3 times next year. Financial markets are not pricing in as much, so there's quite a discrepancy there. The Bank of England has followed suit to tighten, so it's become the first major central bank after the Federal Reserve to raise rates, and it's widely expected that Sweden's Riksbank will also start to tighten. The tapering of the balance sheet in the United States and Europe is being talked about. US is much closer to it than Europe, but clearly the period of aggressive fiscal easing in the major economies around the world does now seem to be over. Global growth looks much rosier than what it did a year ago. It's no longer as fragile as what it was. If you look at leading indicators of global growth, they are suggesting that the global economy will continue to grow at a reasonable pace. Now, global growth forecasts aren't wildly better than last year's, but that's because last year wasn't a bad year anyhow. So we had 3.1% growth in the global economy last year. The IMF is expecting 3.5% this year and 3.6% the year after. It's also fair to say that unusually, or perhaps less typically so, the major risks to the global economy this year come from the political arena rather than macro economy itself. And the global economy also, for once in a very long time, is experiencing synchronised global growth. Deflation whispers have been replaced with reflation whispers. A rise in oil prices and other commodity prices has enabled inflation rates around the major economies to rise, although they do come off a very low base in recent years. The Fed has still is contending, though, with very subdued rates of core inflation in the United States, but it hasn't given up on this idea of the Phillips curve where low unemployment should eventually push up wage pressures. But given that we're really yet to see significant wage or price pressures in the US, that is something that is being closely watched. The Fed's assigning the fact that core inflation sort of dropped away a little bit in terms of growth in the recent months to temporary factors, but that is something to be watching on the radar. Now, whilst we have that backdrop in inflation, it's still the case that underlying economic fundamentals in the United States do suggest that US bond yields should move higher. And then you've got the situation where they should start tapering the balance sheet later this year. The Fed hasn't indicated a timing, but it could happen as early as September, which has given rise to the term Septaper. And that should also add to the upward pressure on bond yields. Now, if Trump's tax cuts and other fiscal stimulus policies also come into play, then that also could provide some upward pressure on bond yields. Now, the ECB is expected to start tapering as well, but we think that'll probably not happen until next year. We need the German election out of the way in September. And even the ECB's president has been talking about reflation rather than deflation. So quite a change in language to what's happened a year ago. Now, Brexit has happened, but despite fears of Armageddon in the United Kingdom, that really hasn't come into play. In fact, the UK economy has held up reasonably well. There are some signs of slowing in the UK economic activity figures, but certainly the worst fears that prevailed this time last year haven't come to fruition. The Chinese economy continues to transition away from industrialisation and an economy that's based on manufacturing. The Chinese authorities have reinforced their growth target of 6.5% this year. The recent GDP figures showed growth of 6.9% in the June quarter, so they are well and truly on course to meet that growth target. Later this year, the Communist Party in China does meet to have their version of elections. If President Xi's powers are tightened, which is expected to be the case, then we might actually see some more longer run and painful reforms occur in China. Now, something that hasn't changed from last year to this year, I should say, but certainly has accelerated the megatrends in the global economy, and these megatrends will continue for decades to come. And the two key ones being demographics. The population of the advanced economies are ageing, including key emerging economies like China, where the working age population has peaked in 2012. And the other key megatrend being the digital revolution, which is speeding up change at quite an exponential rate. I mean, you've got the network of networks, you've got the Internet of Things, you've got big data, you've got robotics, you've got virtual reality, and they're disrupting industries around the world in a big way. And China certainly is a big part of that, given that when you think about China, it will grow old before it grows rich, and 50% of fintech investment in Q1 of this year was actually out of China. Why I mentioned those megatrends is they are speeding up globalisation, and humans, by their very nature, don't like change. And by speeding up globalisation, I think we have seen a bit of a knock-on impact in terms of political developments around the world over the past 12 months. I might leave it there, sort of trying to touch on a few key points around the world.
Thanks, Bessa. I'm sure we'll come back to a lot of those issues. Bill, are you happy to go next? I think you're going to focus on domestic outlook and monetary policy in Australia, and perhaps even the Aussie dollar outlook.
Okay, Stephen, yes. Stephen, just let me, before I do that, but acts as a bit of a foundation for some of the things I'm going to talk about and following on from Bessa's remarks, let me say that I was in Europe and the UK seeing customers, real money managers, hedge funds, central banks in June, And what struck me was the what I consider to be the big theme for policy today. Bessa touched upon it, and that is the, if you call it, flattening of the Phillips curve, or the lack of responsiveness of wages to full employment. If we look around the world, we see US has got full employment. We think their full employment rate's 4 3/4, and they're registering 4.4. Germany's in a similar situation, the UK, Japan, even New Zealand. And yet there's been no wage pressures. And for the central banks that are targeting their policy around inflation, that's very frustrating, because you provide the stimulus, you stimulate, and the key way you stimulate economies is through the labour markets, increasing the demand for labour, which should put pressure on wages and therefore help you achieve your inflation target. It's not happening. So the concern around the world is that this penchant for attacking this inflation target that appears to be unachievable in many countries. Bessa mentioned the US, they got core inflation up to 1.8. Now it's drifted back down to 1.4. About 0.2 of that is so-called one-off, but it's still going in the wrong direction. And wage pressures remain benign. And the issue there, of course, is that if you keep interest rates too low for too long and stimulate targeting that particular target, then you start to create imbalances elsewhere in the economy, and those imbalances are showing up in asset markets. And so we have Germans complaining about house price inflation that I'd never ever seen before, and I've been visiting Frankfurt for 20 years. The French talking about house price inflation in Paris. And the real conundrum of our central banks targeting the wrong thing now and creating big problems as we move forward. So I guess that can bring me on to the local economy. This week we saw the Australian Central Bank finally define where they saw the neutral stance for policy. Up until then, I have been following them for many years, and really there wasn't a whole lot of commitment to telling us where they saw neutral. The Governor Macfarlane used to talk about average rates, and I found that a bit misleading because it didn't take into account the movement in the margin between the mortgage rate and the cash rate, and it's the mortgage rate that affects the economy, not the cash rate. But they've come out and they've told us that it's 1% real, which is the same as the Fed believes will eventually be their neutral, and 3.5% nominal. So that has obviously made people think about, well, will the Reserve Bank be raising interest rates soon? Are they setting down a foundation, reminding people that rates should be back at more normal levels, or is it just an academic exercise? My view is that it's sort of something in between. I think they are closer to wanting to raise interest rates than I think they should be, but it will get down to what I would call a forecasting exercise. So the central bank at the moment has a forecast for growth of 3.25% next year, which is 0.5% above trend. If you believe the economy is going to pick up at that pace, then it's reasonable that you should be starting to claw back some of the extraordinary stimulus that's in the system at the moment. For me, however, I think the economy is actually going to slow down next year. So the 2.8 to 3% that we'll get this year will be more like 2.5 next year. So that'll be below trend, and it really won't justify a case for raising interest rates. And so I think that's where one of the big battlegrounds will be over the next 12 months or so, just exactly how strong is the Australian economy. And some of the factors that are from the perspective that where we see the economy from, which is the second largest bank in the country, is that we are still really saddled with a very cautious consumer. Wages growth, along the lines of the theme that we discussed before, has been benign. Haven't been used to that before. Consumption has not adjusted fully to the weak wages growth, which has meant that it's been subsidised by a fall in the savings rate. But that can't continue. Unless we see some sort of a pickup in wages growth, we're going to see an even weaker consumption environment, which I expect to be the case over the course of the next few years. Question then becomes one of how will business respond to that? And my view is that business will respond negatively. So we're not really expecting to see much of a pickup in non-mining business investment. Non-mining business investment and consumption spending are the two pillars that the central bank is relying upon to see growth go back above trend. The one that we are sure of, and I'm sure they agree with us, is that the housing construction cycle has peaked. Building approvals are now down about 20% from the peak in September. High-rise approvals are down about 40%. So the building activity will be less next year than it is this year. And the last few years, that's been adding to growth. There are some positives. Infrastructure investment will certainly be lifting, and we've also seen some encouraging signs on non-residential investment. But overall, that scenario to me points to an economy that continues to grow below trend, plenty of spare capacity, a rising unemployment rate, and an inflation target that really won't be achieved. So whereas the markets are currently totally confident that rates will start to rise next year with about a 50% chance of a rate hike this year, our view around monetary policy is somewhat different in the sense that we think Australia will be well behind a lot of the others in terms of moving towards that neutral level. Just finally, another factor that I think is important is around the housing market. And one of the other areas for an urgency to raise rates would be to cool housing. It's my view that housing will cool anyway over the course of the next 12 months. The banks have raised interest rates across their mortgage books by about 26 basis points. That includes 76 basis points for investors if they have an interest-only loan, and 0 basis points for an owner-occupier if they have a principal and interest loan. But the average across the whole book is about 26 basis points. Back in 2015, when the banks were also confronted with macroprudential policies, at that time it was to lower the proportion of lower the growth in investment loans. There was also about an effective 26 basis point increase in mortgage rates. And at that time, Sydney house price inflation disappeared over the course of the next 12 months, but was resurrected when the Reserve Bank cut rates on 2 occasions in 2016. I think it's going to happen again. I think we'll see house price inflation disappearing in Sydney and Melbourne and remaining flat elsewhere. So the necessity to raise interest rates to cool housing markets, I think, will be well and truly behind us over the next 12 months. The good thing is that we haven't seen much of a wealth effect with prices on the way up. So prices are flattening out. We don't expect there to be a substantial negative wealth effect. But I'll leave it at that, and we'll obviously come back to other discussions later on. Thank you.
Thanks, Bill. That's quite a sober assessment of the economy and a view contrary to pricing in financial markets, which I'm sure you're quite comfortable sitting in a view that doesn't always fit with the market. So, Warren, you're going to take a longer-term view and perhaps take us through some of the cyclical and structural forces for market pricing, particularly the role of demographics.
Sure, thanks, Stephen. Besser and Bill have given you a good indication of where the debate is in the financial markets at the moment, both internationally and domestically. I thought for my 5 minutes I'd just open up a slightly different direction for the conversation and ask the question about why we are where we are today, and look at some of the longer run, low frequency forces that have driven markets over the past couple of years or longer than that. One of the reasons I'm doing that, it's now 10 years on from the global financial crisis. As Bill mentioned and Dita mentioned, some of the major economies are getting closer to normal. Many of the major economies are at full employment, and some of the major central banks are starting to tighten policy. So some of the cyclical influences that have dominated markets in the past 10 years are about to recede, and it's going to reveal, I think, the extent to which structural changes have influenced market pricing in the past decade. The other reason I wanted to introduce this channel of discussion is that in the past 6 to 12 months, there's been some very interesting work done by central banks, particularly in the US, that have put the role of, or the impact of demographic change on financial markets into much sharper focus than we've seen for some time. And I think the reason that that has happened is we're seeing the leading edge of the baby boom starting to retire, so we're getting a much cleaner read on the data. So my discussion today is really going to be about those long-run, low-frequency factors that are driving markets rather than the here and now. I think most people on the table have probably spent the past 20 or more years working in financial markets. One of the key features that we've confronted in that time is that markets have mostly looked fully valued. Nominal bond yields have fallen on a trend basis and have got to historically low levels. And apart from the odd crisis here and there, equity markets and other asset markets have been strong and for the most part priced at relatively high premiums. Now, part of that story is very well understood. The nominal part of that story is very well understood, and it hardly bears repeating. Central banks have targeted inflation. Inflation's fallen. Nominal bond yields have fallen, and that's cascaded through the financial markets and helped underpin relatively strong valuations. But at the same time, the story about the extent to which real factors have driven financial markets is much less well understood, but we know that real factors have to have been very influential because real yields have also fallen to very low levels, and that's particularly the case in the past decade. We've all known that there are important demographic factors in the pipeline that are going to result in an ageing of the population, result in slower labour force growth, and result in more retirees in the population. I think if most people were like me, we sort of assume that that's going to have an impact on the economy and financial markets at some point in the future, so have pretty much paid lip service to those types of influences. But one of the interesting things, as I mentioned before, of emerging in the empirical literature, particularly in the past 6 to 12 months, is clearer evidence of the influential impact of demographics on financial pricing, particularly in the past decade. There's one paper by the Federal Reserve Board called Understanding the New Normal, the Role of Demographics. If you haven't read that, I think it's well worth a read. It's early days yet. The results may not turn out to be robust, but they're very, very interesting. These papers are finding that demographic factors explain all of the decline in real yields that we've seen, particularly in the past decade. And if you think of the decline in real yields cascading through other asset markets, it's been reflected in the increase in asset prices that we've seen post-crisis. Now, the channels of that influence are relatively straightforward. As the baby boom bulge is moving into retirement, labour supply growth is slowing around the world. So as a result of that, capital is becoming more significant relative to labour, and as a result of that, returns on capital are being bid down. At the same time, as you've got a growing share of retirees in the population, the demand for savings is going up, and that's putting downward pressure on yields at the moment. So these findings are consistent across a range of countries, and I think when you put those findings together with the better understood role of the decline in inflation, it helps put the last 20 or 30 years of asset markets into perspective, that you've seen inflation fall, you've seen a very big demographic change starting to hit economies now. Both of them have worked in the same direction to reduce prospective returns, and the way mostly that prospective returns have been reduced is that current asset prices have been bid up. So we've seen low yields go hand in hand with strong asset markets, and the common factor between those two events was the decline in inflation and the demographic changes that we're witnessing at the moment. So that's the past. What does it say about the future? And I think there are a couple of interesting things in this work that are worth thinking about. One is, as I said before, the work shows that all of the decline in real yields is due to demographic changes. And the most interesting thing is the paper I referred to asked the question, what if we went back to 1980 and all the information we had was just about the demographic profile of the US? And it finds if that's all you had, it would have explained the future path of real discount rates across markets in that time. So you put both of those two observations together, it suggests that demographics have been very influential. And I have to qualify this by saying past returns don't necessarily reflect future performance, but it suggests that people who are thinking about financial markets, particularly thinking about overall returns in asset classes, have to place much more emphasis on the role of demographics than I think they've done historically. The other interesting result is that the impact of demographic change was much more significant in the past decade than it's been in prior decades. So for financial markets, that means they've been hit with a global financial crisis, they've been hit with 10 years of extraordinarily easy monetary policy, and they've been hit by a very significant demographic change at the same time. So working out the impact of each of those forces individually is pretty hard, but the fact that they coincided means that it's been very difficult to assess where markets should price and where they're headed. But the fact that we're now 10 years on from the global financial crisis, and central banks, in some countries at least, are starting to adjust policy, means that we're going to get a much cleaner test of the role of cyclical and structural factors that have driven markets in the next couple of years ahead. Now, Australia is very interesting in this context. We also have an ageing population, but our demographic profile is much different to other countries because we've still got very strong population growth. So I think it means that people who think about Australian markets have to think about what that implies. My guess is whatever happens in global markets is surely going to dominate what happens in Australian markets. But the fact that we have a very different demographic profile suggests that we should nuance our thinking a little bit. So if I bring all that together and conclude with three observations or three questions, one is that the significance of demographic forces has been crucial and it's probably not well understood. But I think because it's happening right now, we're actually getting a cleaner read on its impact. Time will tell whether these studies prove to be robust or not, but they're very interesting and certainly worth thinking about. The other thing is, in the next couple of years, we're going to get a meaningful test of the impact of cyclical and structural factors on market pricing as economies normalise and as policy normalises around the world. And the final observation is really a question. If demographics are as influential as these studies suggest, and Australia's demographics are different to other countries, does that mean that we should think differently about market responses in Australia? I think I'll leave it there for questions.
Thanks, Warren. There's some fascinating insights there on some of those more longer-term forces driving markets. But perhaps I'll go to questions from the floor very soon. But I just wanted to throw at the panel a question about bond markets particularly. Like Bessa mentioned at the outset, we've got global growth picking up, we've got inflation picking up, we've got key central banks starting to raise interest rates, particularly the Fed, but now the Bank of Canada and some of the other ones that she mentioned as well. But on the flip side, we've got even the European Central Bank talking about withdrawing perhaps quantitative easing over the next couple of years. So some pretty large forces going on there. I'd just be curious from the panel if you can talk about where you think bond markets are headed over perhaps the nearer term, maybe the next 12 months, given all these different forces that are going on out there. Bill, you've got obviously a much more downbeat view about Australia than perhaps the consensus, but who wants to tackle that first about bond markets?
Steve, yeah, look, our forecast is that the US Treasuries will be at about 3% by the end of next year. That's on the basis that the Fed tightens 3 more times. So the cash rate will be 1.85 and Treasuries will be about 3%. That's obviously likely to be the high point in the cycle. As Warren indicated, demographics are having a big impact upon growth. So when we think about growth, we think about the participation in the labour force plus productivity growth. In the US at the moment, the labour force is only contributing about 0.5% to GDP. Sorry, normally would only contribute 0.5%, and productivity is only growing by about 0.5%. You're getting 2% growth because of the increase in the participation rate, but the actual population growth story is pretty low. So with growth only running at around 2%, then you can't really expect nominal interest rates to be too far above that level of growth. Can we get a higher level of productivity? Of labour force contribution? As Warren said, the dynamics around demographics are quite powerful. What we don't understand is why productivity has been so low. I think low productivity has actually been one of the reasons behind the low wages growth. If I'm an employer and I'm not getting much of a pickup in productivity out of my workers, why should I reward him with a wage increase? One factor may be low business investment, which has held back productivity growth. Another factor may be that we're not measuring output correctly anymore through technology. You take, say, the whole photograph industry. 10 years ago, people were getting paid to process film, people getting paid for make cameras. Now there's many, many more photos in the world, but no one gets paid for it. They're all free. So GDP actually falls as a result of an increase in activity. Banks are trying to phase out a lot of products that they used to produce, which they can through better technology. So technology's really distorted our ability to measure progress in productivity, but bond markets will always be driven by what the printed growth looks like. So that will tend to hold down that level. Another way to look at it, every bank you talk to thinks they'll be able to do their own business with a lot less people going forward because of technology. So at individual companies, productivity should be increasing, and yet at the macro level, it's slowing down. So there's a lot of puzzles around that, but the fact that the economic growth numbers are reflecting the standard productivity measures will certainly hold down the level to which bond rates are likely to reach. The other factor, of course, and now I'm talking as an old bond trader because Stephen talked about my career, and for many, many years I was running bond trading operations, and now with the Fed shrinking its balance sheet, the number one rule in bond markets for old bond traders is, hey, what's the Fed doing? Oh, the Fed's buying. Oh, I'm buying. What's the Fed doing? Oh, the Fed's selling. I'm selling. So what might happen when they do start to reverse the QE process? Markets may react a little more brutally than they're currently expecting.
We've got a similar view in that we do expect more rate hikes from the Fed, one more this year and 2 or 3 next year. We do expect that bond yields will be at a higher level at the end of next year compared to now. There will be a bit of volatility in between that. Bond yields bottomed in the major economies in July or July of last year. They haven't risen substantially, and again, I think part of that story is the demographics, inflation, the productivity that both Bill and Warren have talked about. Now, bond yields also rose considerably when Trump was inaugurated because there was a belief that a lot of his policies would come to fruition very quickly, and they would then boost growth in the US economy. And remember, underlying growth in the US economy was already firm before Trump took to the podium, and that would boost inflationary pressures. Some of that has been priced out earlier this year because the markets realised that some of his policies might not come to fruition or might not come through very quickly. Certainly, if some of his policies do come through because they are stimulatory, that will add to the push higher in bond yields. Also, the normalisation of the balance sheet should also push yields higher. The Fed's done a paper and they've estimated that the quantitative easing was worth 100 basis points of the term premium in bonds. So that alone sort of suggests that, well, if you're going to start to then shrink the balance sheet, then that should actually pressure bond yields higher over time. Now, Australian yields are also moving higher, not by as much as US yields, because our domestic story is different. So whilst the US Fed is hiking rates, the RBA is on hold, and I agree with Bill. I don't think they're about to raise rates in a hurry. So our domestic story is different, which means our yields are being dragged higher by US yields, but not by quite as much. And I think that pattern should still continue over the next 12 to 18 months.
Yeah, just a quick comment. Like Bill, I'm an ex-bond investor, and one of the things I learnt is never give a forecast about bond yields as a result of that. But I think,
you could say that, I think, about almost any asset class, don't you think?
So, I think the observations that Besser and Dieter have made about the longer run influences on bond yields are likely to be the case, and we'll end up with yields lower than they have been on average historically because of that. But I think Bill's point and Besser's point as well about how the market responds to policy changes is very important. I guess policy... When central banks hit this zero bound, policy was transmitted by forward guidance anchoring short-term interest rates across the yield curve, and by quantitative easing having an impact on the term premium being embedded into markets. And I think, as we've seen central banks talk about tightening more, and the Fed actually tightening, you've seen an adjustment in short-term interest rate markets, because forward guidance is obviously not relevant anymore in those circumstances. But we're yet to really see much of an adjustment in the term premium, I think it's fair to say. And when QE eases, it's going to be an open question about whether that remains the case.
Can I also just add, financial markets are experiencing extremely low volatility. So whichever volatility measure you look at, it's very low. So, for example, the VIX index, which is... a measure of volatility out of the Standard & Poor's share market index in the US, that's at levels, we haven't seen it since the early 1990s. So that's suggesting there's not a lot of movement in prices. The Australian dollar, I think, really highlights that. It's only really moved, 6 US cent range this year, and it typically, in any year, on average, moves about a 20 US cent range if you look at it over the past 20 years. So there's very low volatility in financial markets, which is quite unusual. That can continue, of course, but there is the risk that, of course, volatility will break out, and that then sort of has a shakeout in terms of asset pricing.
I'll ask one more question and then we'll put it out to the floor. But Besser, just picking up on that point about volatility, volatility is very low, and yet every time I speak to investors or in my readings, they talk about heightened uncertainty with things like the implications of Brexit, Trump's policies, setbacks on healthcare and other policies, geopolitical events clearly that are pretty serious. Why are equity markets trading at record highs, or most of them, not Australia, but most of them? Is it more to do with the Trump trade than anything else? But as you mentioned...
I don't think it's purely a Trump trade. As I said,
markets are losing
markets
faith
took
in
a bit
that,
of a reality check I think it's got to do with where the risks lie. I think there's a dichotomy in terms of risks. If you speak to an economist, we talk about political risks, which are quite heightened and obviously can have then an impact on economic risk. And I should also throw in there's also geopolitical risk. But as you correctly pointed out, those people trading billions of dollars on floors around the world, they see risk as quite low because, when you look at these volatility measures, they're telling us that they're pricing risk, they're not pricing very much risk at all. And that's almost, I guess, comes back to what also Bill touched on, which is there's not much inflation, but interest rates are very low around the world. Should we then keep interest rates low, despite the fact inflation hasn't hit targets, because keeping interest rates low for an extended period of time can actually build up risks in an economy? And we might be seeing a bit of that at the moment. Interest rates are really low, so people aren't pricing in much risk, yet there is risk out there, particularly from the political arena. Some of that's probably subsided a little bit post-French election, post-UK election, but it's certainly still there, and that's why perhaps there is some argument that maybe central banks should start raising rates even though they haven't hit the inflation target, because keeping rates low for too long can create other sorts of risks. So I think it's low interest rates that are actually probably one of the key reasons that's feeding the asset market, more so than, say, the Trump trade. The Trump trade is part of it, but I don't think it's entirely there because, those prices were rising even before Trump took to the podium.
Thanks, Bessa. Bill or Warren, on comment on equity markets?
Steve, I think there's also an element of people are uninvested. There's still a degree of uninvestment out there. And so the alternative returns on markets are pretty low. So equity markets retain an attraction like that particularly for retail investors. And I do believe that equity markets have not given up on Trump, whereas the bond market has. So one of them's going to be right. My view is that he will get something done. In fact, I think that the failure of the Obamacare legislation may well open the way for tax cuts now that they realise that they've only got one shot out of the barrel to use their raw majority in the Senate. So we may start to see some developments on the tax cut front.
Thanks, Bill. First question. So there's one down in the middle here.
Sam Wills from Sydney Uni. I just want to get your thoughts on household debt and how that's going to be resolved in Australia. So how much do you think that it's weighing on demand? And what are the risks that we're going to have policy mistakes, using these macroprudential tools, which are in a sense a bit unfamiliar?
I might start off. I think obviously it's an issue for policymakers that household debt is at a high level and it has risen very strongly over the past couple of years. And a large part of that increase has been to investors in the housing market. So the fact that the economy households have a lot of debt is clearly a vulnerability. It's a vulnerability that a lot of countries face. And it may be a factor in people's spending decisions. One of the charts we had in the budget paper had information on consumer spending pre and post crisis, and clearly it's been slower on average since the crisis. That may reflect a desire by people to strengthen their balance sheets over time. Observation doesn't obviously sit very comfortably with investors being a prominent part of the housing market. The macroprudential tools, they're there for a purpose, and one of their important purposes is making sure that the banks themselves are resilient if it comes to be the case that there is an event in the housing market or constraints on the household sector. So they're not necessarily implemented to achieve an outcome about household debt. They're implemented to complement the range of things that APRA have been doing over the past couple of years to ensure the soundness of the banking system.
I guess it's also a case that when the RBA eventually does start raising rates, that they won't need to take rates up as high as in the past, because interest rate hikes will have a lot more bite because of the size of household indebtedness.
Yeah, it's a pretty nasty combination, isn't it, really, the very high levels of household debt, just at a time when income growth is very weak, which exacerbates the vulnerability to those high levels of debt. And as I said, we saw that example in 2015 where the macroprudential policies led to the banks raising rates across the board by about 26 basis points on average, partly due to that and partly due to the need to hold more capital. And that did the trick in the Sydney housing market. There was an impact on investors from the supply, but it indicated that house price inflation was dealt with pretty quickly. We do know house prices can fall. They fell by about 8% in Sydney and Melbourne in 2011 and in 2007. They were both under the weight of mortgage rate increases of 200 basis points. And of course, when they fell by that amount, the Reserve Bank reversed policy and they had enough fat there to really offset that. So they then started to cut rates and that stabilised things. The thing now would be, if you mentioned macroprudential. There's a debate on macroprudential as to whether the effects are lasting. So why did house price inflation re-emerge in 2016? Certainly the RBA cut rates in May and August, that was a factor. But secondly, it may be that the effects weren't long lasting. To the extent that the authorities believe that, and we start to see a resurgence in house price inflation, then we'll get more macroprudential. They obviously don't have much scope to raise rates, to cut rates any further. So it is a knife-edge situation, and it's something that the people in the finance industry watch very, very closely. For the banks, I think the other issue on stability is very much one of the perception of foreign lenders to the Australian housing market. Whenever I go overseas to talk to customers, that's the first thing they want to talk about. You know, when is the housing market going to blow up because of these excessively high levels of debt? So if you started to see evidence of that happening, then foreign lenders might decide to cut back their lending to the banks. And as you know, the banks are totally reliant upon, we're the ones that fund the current account deficit and the foreign debt. So we're totally reliant on that. So that particular dynamic is also something where the housing market could have a substantial negative feedback effect onto household debt in the banking system.
So just a follow-up. Excluding the possibility of like Armageddon with a huge collapse in house prices, how do you see Australia bubbling along with the same very high level of household debt, or do you see a deleveraging on the horizon, and are you worried about that?
Look, actual housing affordability is very high at the moment. That's because rates are so low. So people that just look at price to income ratios don't take into account how low interest rates are in Australia. Clearly that would totally change if we saw some extraordinary lift. And from my perspective, that discussion this week that 2% on the mortgage rate is only neutral. Well, we saw 2% on the mortgage rate in 2007, in 2011, lead to a genuine fall in house prices. So I think things are a lot more sensitive than that. So what it's saying is that yes, as Bess has said, yes, the economy will be extremely sensitive to interest rates. And then the worry is that you make a policy mistake. And when we think about the only recession that we've had, well, we had a couple in the 80s, but the last one was a big one. That was a policy mistake when the central bank and Treasury set interest rates at 19% because they thought the way to control the economy was to bring down the current account deficit. It's a total disaster, policy mistake. So it'll be a policy mistake once again that could lead to this, but I think I'm pretty comfortable about the people that are holding the levers at the moment.
Interest rates remain the big driver for house price direction. We looked at the Vancouver experience because Vancouver, like Sydney and Melbourne, have had a huge influx of foreign investment into the residential housing market, and they've also had house prices growing at a very fast rate. And then they've also had some measures come in from the government and policymakers to try and restrain housing. And really, the pace of house prices growth slowed somewhat, but you certainly didn't see house price falls in Vancouver. And the same with Australian housing. As Bill pointed out, we saw house price falls in 2011, but that was in the wake of, you know, a number of RBA rate hikes. It wasn't even the GFC that really produced those falls, because the GFC started in 2007. It was really the weight of, you know, those RBA rate rises. So interest rates are very critical to housing prices. So is unemployment, but you need to see a much higher rate than where unemployment is at the moment. It's hard to see unemployment reaching the sort of levels that would produce, you know, widespread house price falls.
Just on unemployment, have we got accurate figures to base our assumptions on? If you look at, say, Roy Morgan, you're looking at 19% underemployed, 8.9% unemployed, versus ABS 5.7. I think that's what's really causing the productivity problems, that we've got a large run of underemployment, because we're only measuring unemployed people now.
Yeah, arguably that could be the case, but what we're interested in is the change.
Yeah.
So if Roy's got a different way of measuring it, it still matters. What still matters is whether that rate has gone up 10 basis points or whatever, because it'll be the change that'll be the thing that'll impact upon the economy, not the actual level.
But you're saying that underemployment. Right?
Yes, and the ABS is also pointing out that while the unemployment rate has come off from 6 to 5.6, the underemployment rate has gone the other way. So that's one of the other factors, I think, in the case of Australia, that's constraining wages, the existence of this high level of underemployment. So there's lots of other reasons. No pricing power from business. Business doesn't have any pricing power. Why should they award you with a wage increase? Low productivity. Why should you get paid a wage increase if you're not productive? Fear of the GFC. Why would I change jobs when I was so fearful last time around? So there's lots of reasons, and the underemployment could be another one of those reasons. And as I said, to me, that's the really critical issue around for markets and policy.
It's a complicated issue as well. Obviously, the underemployment rate is higher than the unemployment rate, and it's risen over the past couple of years because people are working fewer hours than they would like to. So at face value, that's not a good thing, and obviously it's creating more excess supply in the labour market than would otherwise be the case. But you look at it from a slightly different angle. It's one of the ways that the labour market's adjusting to a pretty big negative shock from the decline in commodity prices and mining investment. So yes, there might be a lot more people working less hours than they would like, but maybe the corollary of that, if that hadn't happened, there might have been more people entirely out of work. I don't know the answer to that question, but that's a reasonable supposition. So as a statement of facts, it does mean that there is pressure on incomes and excess supply in the labour market, but as an adjustment mechanism, it may be having desirable outcomes as well.
The other one that bothers me a lot with our labour market is that globally our wages are very high. So are we overpaying ourselves? So the adjustment that's going on globally, do we need to make an even bigger adjustment? And that's very sobering. Very sobering.
I mean, in recent months you have had some of the part-time workers rotate into full-time employment, and we've seen that with the improvement in full-time employment growth. and a bit of a slowing in part-time employment growth. So that suggests perhaps there's a little bit of improvement that's been coming through, at least in the last 6 months, in terms of underemployment, or those people that want to work more hours, working more hours. The productivity question, that's prevalent in other major economies, and recently we did have a Fed speaker speak to an Australian business economist event that we're on the committee for, and he surmised that perhaps because the world hasn't had a really major, I guess, breakthrough technologically, or like the car, like the iPhone, smartphones are now 20 years old really, or 10 years old, but in the last decade we haven't really had any sort of major item that really changes the way we work, that would really lift productivity in a major way, and he surmised that maybe that's part of the story. I also do think that with the increase in digital innovation, we're really not measuring economic activity properly, we're not measuring inflation properly, we might not even be measuring productivity as a result. When you think of gross domestic product, that was a measure that was developed in the 1940s when manufacturing was a huge chunk of economies. But now technology and innovation is so much more important to an economy, but we really don't pick it up completely in GDP measures. So, for example, if there's advertising on Facebook or Twitter, that has a value, but in GDP that would be zero. Yet there is a value there because that's advertising, that's selling a product. Also, the digital revolution has given rise to a new economic model, which is the shared economy, where you can rent out something you're not using online to someone that might need it. And that's not just your room, that's your handbag, that's your bike, that's your pet, that's a whole range of items, which means that you're using resources more efficiently, which really means you don't need to produce as many goods and services. You've got driverless cars that are coming through. Will we need to produce as many cars? Will car prices then come down? So I almost think there's a structural influence on prices, and we're not necessarily picking that up, just like regulation isn't picking up the digital innovation as well.
Thank you, panel. There's another question right here.
My question is, what is the percentage chance we're going to have another financial crisis bigger than the last one? Because it seems that there's a lot of confusion about the financial markets not being fit for purpose. Bill's got confidence that people with their hands on the levers of power, they know what they're doing, but their actions speak otherwise, because at the Federal Reserve retreat in Jackson Hole last year, the lead paper was on how to increase resiliency in the financial system. You have Andy Haldane at the Bank of England talking about the doom loop, and that's what Bill was mentioning about our foreign exchange reliance on, we interlock to everybody else. I mean, it's ridiculous. You've got national currencies, but you can't control its behaviour. I don't think our national currencies are no longer fit for purpose. With this floating exchange rate is not fit for purpose of giving certainty for investors and isolating us from the crises elsewhere. The US government said the main cause of the financial crisis was not the subprime mortgages, it was a deep failure of corporate governance, and there's been no change in the toxic corporate governance system we had in 2008 of the 56 financial institutions that needed a bailout, not from the Federal Reserve, which is designed to provide bailouts. It was the governments that provided the bailouts, and all those financial institutions that need to be bailed out all complied completely with the corporate governance rules, which suggests that the corporate governance rules are the problem, not the solution. So do you think the system is ready for another crisis? And give us your estimate, please, because a lot of the people with hands on the levers of power feel there's great uncertainty in that. And that's maybe why the equity markets are up, because the fixed interest markets are very unpredictable, unstable and indeterminate.
Quite a few views there as well as questions.
I think the US regulatory authorities after the GFC, I think they did do a lot of work with stress testing the banks and
no changes in corporate governance. No changes.
Yeah.
And yet they said that was the main cause.
I would think there were a couple of causes of the GFC. One of them was that, Fed Chair Greenspan kept the US Fed funds target rate at 1% for too long. That's one factor. Another factor had to do with the way mortgage-backed asset securities were understood by.
I might jump in there. I put the probability on a financial crisis bigger than the last one at infinitesimally small levels, partly because it's a high hurdle. The last one was the biggest one ever, so that's a big hurdle to jump over. And I think what regulators have been doing in the past decade has strengthened the solvency of the financial system. It's increased. Yeah, that's fine, but I think as a statement of fact, the financial system's much more solvent than it was, much more liquid than it was. So I think it's in much better shape than it was.
I agree with you in one way. If I try and work out where was the real issue with the GFC, obviously misbehaviour at the micro level in the mortgage market was clearly mortgage brokers were misrepresenting the finances of borrowers. People who couldn't afford one mortgage were being lent many mortgages because... And why was that? Why were they generating all these mortgages? Because Wall Street wanted to create the securitised assets and they found that people wanted to buy them. And why were they prepared to buy them? Only because rating agencies made them AAA. And why did they make them AAA? And this is your corporate governance issue. Partly because if they didn't make them AAA, the guy down the road would. So there's a lot of liquidity that was generated for these toxic waste assets as a result of the AAA rating. Because certainly the Korean Farmers Association would not have been buying subprime mortgages unless they were rated AAA. So that particular process, that rating of rubbish at that level, I think was something that without that, the crisis would not have occurred. So I agree with you. I think there's issues around that particular process that still haven't been fixed.
The core role of the bank is assessing risk, and they're still failing. You've got two Italian banks failing just recently. They weren't bailed out by the European Central Bank. They went back to the government. And governments are loaded up now.
Well, certainly one thing that would not happen if we had another crisis, Lehman wouldn't have been allowed to go bust, because the impact on the rest of the world from Lehman, given their connection, given their interconnectivity, was much more devastating than the cost of bailing them out. I think the regulators understand that as well.
Yes, Michael Potter. So Bill Evans mentioned something about the economy being, quite sensitive to interest rates. But there is something which is puzzling, which is the lack of business investment. So we see the economy is sensitive to interest rates, but it doesn't appear as though business investment is responding that well to the ultra-low interest rates that we're seeing in Australia and probably in other countries. So how do you explain that puzzle? Why are we not seeing fairly substantial rebound, particularly in non-mining investment, which is sort of flatlining at reasonably low levels? It hasn't rebounded dramatically since the mining boom. What's going on there?
There are some sectors where you are seeing better investment occurring, for example, education, health and agri, but that doesn't get picked up by the main survey of capital expenditure that's published by the Bureau of Statistics. But even leaving that aside, you haven't really seen the pickup that one would expect. The RBA's done some work around that, and in my discussions with some of our clients, it does seem to resonate, and that is after the GFC, when after the RBA had finished tightening rates in the last cycle, and rates started to come down. Typically, you'd have hurdle rates, otherwise known as the required rate of return on investment projects, come down with it. But in fact, what we've seen is that the required rate of return stayed sticky at a high level. So you needed to see a much higher required rate of return for those projects to actually go through. And I think that's actually hurt business investment in the post-GFC period, even though, the GFC was 10 years ago. So I think that is part of the issue. Business confidence is very high and business conditions are improving, but we haven't yet seen, the penetration in business investment that one would expect, and that's possibly part of the story.
Yeah, I think it's a global phenomenon. Investment in Australia has been weak. There's the mining story, obviously, which is a separate story, but non-mining's been weak. That's been a characteristic of this cycle around the world, even in countries like the US that have got back to full employment. So while for a long period I think you could attribute part of the weakness in investment to just excess capacity in the economy, and I think that's still part of an influence weighing on investment in Australia, it's getting harder to make that connection in places like the US, where the unemployment rates have fallen to very low levels and the economy's done very well. So I don't think people have come up with a good answer to that puzzle. I think the impact of the financial crisis has probably made businesses much more cautious, particularly about committing to large investment projects. I do wonder whether the speed of some technological changes is also having an impact on in business. If you're in a traditional firm and you don't know whether your industry is going to be disrupted by technology, what do you do in those circumstances? In Australia, I suspect that the decline in mining investment had a bigger spillover into the non-mining investment side than perhaps people assumed at the start of the downturn in the mining investment cycle. So there are a range of influences. It remains a puzzle. For Australia, as Bess has said, some of the business indicators are looking better. So time will tell whether that gets reflected in better business investment going forward.
I think the other thing is, particularly in the US, CEOs get rewarded from the performance in their share price. Taking a risk on investment isn't usually rewarded in the share market, but using your liquidity to buy back your shares or raise or pay high dividends is. And so that's been a factor in the US in particular.
If I can, I might just build on this question and bring in some of the commentary that was made by Warwick McKibben yesterday, and also come back to what Bill said about the next recession might come from a policy misstep. Professor McKibben made the observation that there seems to be tremendous policy uncertainty in Australia at the moment, and there isn't a lot of commonality between the two major parties, and as a result, making policy choices like a bank tax or changes to carbon reduction policy could basically put a dampener on a business's willingness to invest. I was wondering if you had any perspective on the role of policy uncertainty in contributing to potentially low business investment.
Yeah, I think that's right. I think that businesses don't like uncertainty, and undoubtedly in the current political situation that we have at the moment, there is a high degree of uncertainty with the Senate being so powerful, with the government not being able to implement most of its program, with the polls indicating that there's likely to be a change of government if there was an election in the near term. I think all of that uncertainty is weighing on business. It's probably not extreme now, but in a year's time, when the election will only be a year out, I think it'll be a factor in terms of business delaying decisions. So, I better not do that. I better see how this election comes out. That we see that in the data all the time, and the degree to which activity slows in the lead up to an election, that's getting longer and longer, that period. And I think we may end up with another one like that again. So that's one of the reasons why I'm pretty downbeat about the investment outlook for next year.
Some companies in some states and territories also really face energy issues. So particularly high users of gas, electricity. When we speak to our clients, particularly in South Australia and Victoria, that's a big issue for them. We recently visited a client where their gas costs basically doubled in the space of a year, and they're now at risk of bankruptcy, and they're a 120-year-old company. So I think that's also a very real issue for companies, and that also sits with government policy, and the government has made some announcements around energy, but I'm not confident that's really going to address the energy issue.
Warren, did you want to make a comment there? Or?
No, I'm fine, thanks.
Any more questions? Go over here, then here. Excuse me.
Sorry. Kyle Thompson from BITRE. I see that the private sector panel members tend to use the words policy and political interchangeably, as in policy stability and political stability. And I wonder if actually that's a misunderstanding of our way our government works to some extent, that we might have political instability, but that's not necessarily policy instability. Is there a difference to you?
Warren, you might want to steer clear of that one.
Yeah, I think I will. I'm not quite sure what you mean. So if you have political instability and the parties have different policies, then you'll have policy instability. If you have a situation where the government of the day doesn't have a majority in the Senate, then that's politically unstable, but it also is policy unstable because you're not sure which of their policies they'll be able to actually put into law. Am I missing something here, or is that, are you, I'm not surprised that they are interchangeable.
No, that answers my question. Yeah. Do see them as interchangeable, essentially. And that answers.
I mean, it's even harder to get policy stability. There's political instability within the party themselves. So there's not just political instability, I guess, in, you know, when you have a minority government, but it also can arise if there's a lot of instability within the party itself.
Just a question on quantitative easing. Seeing that the Fed Reserve's only starting to unbundle it now, their balance sheet, are we in a position to say that's a good mechanism? I mean, I think it's done its job over this period, but are we in a position to judge longer term whether it's a good lever to use or not?
My view on that is that we asked, Besser talked about the FOMC member that addressed the ABE last week. And my question to him was, because they all have to put forward their profile for interest rates, and I said, now that the balance sheet shrinking policy is underway or is ready to be announced, does that change your view on your interest rate profile? In other words, with the balance sheet shrinking, does that mean you won't need to adjust interest rates by as much? And his answer was, well, I always assumed a balance sheet shrinking, so I'm not changing my interest rate profile. For me, the worry would be if the balance sheet is used as a substitute for raising rates, because in my opinion, they are in a situation now whereby, as Besser said, they've raised rates 4 times, and yet financial conditions in the US have eased. So that if you like, they've got away with 4 rate hikes and not really done any damage. So I would like to see them continuing to do that, because as one of the other members of the audience said, there's going to be another downturn. Let's hope it's not like the GFC, but there will be. So the degree to which you can accumulate some buffer now at a time when the markets are letting you do that, then by all means do it. But if you do it if you use up that opportunity to shrink the balance sheet, and no one really knows the degree to which the balance sheet is distorting the economy. We have no idea whether if they reduce the balance sheet by $1 trillion, whether that in any way will help US economy. So if that's used as a substitute at a time when you can get some interest rate hikes away, then I'll be disappointed. I would much rather the policy that they originally adopted, which was to say it's going to be about interest rates, because we understand how that works and we don't understand how the shrinking of the balance sheet works. I would rather see rates get back to neutral and then start to consider shrinking the balance sheet. That would be my advice. But they didn't listen to me, did they?
I think if they can shrink the balance sheet over time and get it to a reasonable size, then perhaps the long run will say that, you know, it has done a reasonably good job. But in between, they still run the risk of another shock coming, a wild card, and they have a dirty balance sheet because they've basically taken on the risk from the market sector onto their balance sheet and dirtied their balance sheet in the process. So it really depends on how they go from here to normalising it. Clearly it did its job because it did reduce long-term interest rates in the United States, and mortgage rates in the US are tied to the much longer run yields. And we did see the US housing market particularly hard hit when the GFC occurred. And as a result of pushing down on yields, the US housing market was able to recover, so was the US consumer, and that's really what then enabled the recovery to be wider spread. So it did its job, but really I still think you need to see where it gets to between now and then.
Yeah, I mean, it's a good question. I think Bess is right. In terms of looking back, it's definitely done its job. The US needed other means to ease monetary policy when they hit the zero lower bound, and QE and also forward guidance seem to be very effective in changing financial conditions. So I think history will judge it working very effectively to absorb the impact of the crisis. It's an open question how the markets are going to respond and how the economy responds as the QE is unwound. I think the Fed will be very careful about it, and we'll have to be very conscious of the fact that we haven't been through this before, so we have to be prepared for uncertain outcomes. I mean, one of the issues is that not just the Fed, but other central banks that have been in the same position over the past decade have provided very strong guidance to markets about interest rates by both telling them that short-term rates are going to stay zero forever and also investing in longer-term bond yields. And both of those factors are changing now. So some of the guidance to markets is starting to loosen up. But I think that's a good thing. Ultimately, you don't want central banks heavily invested in fixed income markets, and you want the markets themselves to determine what the appropriate yield is.
Hi. With the domestic economy being pretty weak and sluggish, and recently fiscal policy injecting infrastructure spending, do you guys, predict that there's going to be more fiscal policy in the short to medium term coming through? I know that you discussed there's a lot of uncertainty, but it seems that there will be a greater need. And do you think what types of fiscal policies would be coming in the short, medium term?
I think you've got to remember that the government is very much committed to retaining the AAA, and one condition there will be to be able to continue to forecast a surplus by 2021. The rating agencies seem to be comfortable with that as being a realistic target. So if you were to succumb to the temptation of a big fiscal stimulus in an election year, which has happened in the past, if you recall John Howard's policies in 2007, where he had these massive tax cuts, and all Rudd did was say, yeah, well, I'll do the same. So it didn't sort of help either of them politically. I don't think the government's got that sort of flexibility for that sort of a large fiscal stimulus, given that there are already question marks about the achievability of the 2021 surplus, and that's considered to be a non-negotiable aspect of government policy to retain that AAA.
We've talked about wages being so low in Australia and around the world, and one of the ways in which the government has forecasted getting to 2021 a surplus is, conditional on wages growth picking up quite sharply over that period, and that doesn't seem like that will be possible, and therefore it does seem difficult to imagine that they will be able to do substantially more fiscal policy, given, as Bill's highlighted, they have backed themselves into a corner in terms of delivering that surplus in that timeline. Can I just add, some of the state governments are trying to do more. So we saw $1 billion in infrastructure spending announced from the recent Victorian government, and South Australia is also trying to do more. It's trying to introduce a state-based bank tax in order to fund more infrastructure spending. The ACT's state budget this year, territory budget this year announced more, and the WA Premier has said he's watching what happens in South Australia because they might follow suit. So some of the state governments are actually doing a bit more, I guess, on infrastructure spending, which would feed through to their economies.
Last question. We've got time for one more.
Just following your discussion, recently Bank of International Settlement, they released a report that was about financial stability oriented fiscal policy. So do you think a fiscal policy in Australia is going to do something with financial stability of banking sector?
I'm not sure I understand the question. Do you mean, will the government introduce measures for the financial stability? Is that what you mean?
No, actually, the way how Bank of International Settlement, their view was that fiscal policy is transmitted into financial stability of the banking sector, the way how they define financial stability of the banking sector, like tier 1, tier 2 ratios. And the same thing, APRA is implemented here, like as if you have a look on APS 110 to APS 120, APRA define financial stability of the banking sector like tier 1, tier 2s. So do you think that if government does some kind of fiscal consolidation, so this thing can transmit into banking sector stability?
I think financial stability is very good in Australia. The RBA publishes the Financial Stability Review every 6 months, and it goes through all the indicators, the stress testing, and it's quite evident that financial stability is very strong in Australia. So I wouldn't expect that to change anytime soon. I think the regulators, have a good handle on that. I think part of the expansion of the macro-prudential measures on housing is about ensuring that financial stability stays in good shape so that the banks are well capitalised in case something does happen in housing. So I think financial stability remains sound in Australia. And in terms of the ratings agencies, they're really, I guess, they've reaffirmed the AAA sovereign credit rating. Standard & Poor's still has Australia on negative watch, but I think that's more to do around budget repair and getting back to surplus in a reasonable timeframe.
Bill or Warren?
No, obviously financial stability is really important for your fiscal estimates. If you were forecasting financial instability, then you would have to forecast a substantial downturn in your economy, which of course would lead to a blowout in your budget deficit. So financial stability is almost a given from the perspective of your budget estimates. Warren's involved with the budget estimates, and I'm sure when he sits down to forecast GDP in 3 years' time, he isn't assuming financial instability, because that would just throw everything completely out the window. So it's very, very important, and we've been very fortunate that the Australian banking system has been probably the main reason why we avoided a recession during the GFC. The banks remained open for business.
Actually, crisis has not been, like Australian economy has not seen crisis over the last couple of years. That's why this crisis has not been the concern in Australia. But definitely there are empirical evidences like for other economies where financial instability leads to fiscal crisis and we see that this
No, I completely agree.
But this has not been the case for
So why do you think the banks got taxed in the UK? Because they deserve to be taxed, because it was their poor performance that led to the massive blowout in the budget deficits in the UK. Somewhat different to the reason for the taxing of the Australian banks.
So it's approaching 5 o'clock, so we should bring this session to a close. Thank you very much for attending and for your interest. Please join me in thanking Bill, Warren and Bessa. Thank you very much.